Hey, hi everyone. I'm CA Vijay Kedia. Welcome to my channel. Today, I'm going to cover a very hotly debated topic in this video, which is real estate versus equities. And the reason I wanted to make this video is whenever I talk about this topic with my friends, colleagues, or relatives, I always hear that real estate is the only like the real investment where you make money. And so they'll also give an example how somebody made like fortune in real estate. And then when you talk about the stock market, they'll give examples like people lost money and things like that. So the point here is that whenever we talk about a particular asset class, we need to cover all the aspects related to that asset, because some asset might not be suitable for someone, but it might work for someone else, and vice versa. So the thing is, don't go by what someone else is saying or doing, right? And you need to do your own research. So sometimes people buy real estate out of FOMO because everybody is buying, or sometimes people buy a particular stock because market is going up and that stock price is going up, right? So the purpose of this video is that I'm going to cover like some 8 9 different aspects related to real estate and equities, which will help you to make an informed decision that which one is the right asset class for you, right? So with that, let's start. So first one, which I wanted to cover is the liquidity. So I think you all are aware in terms of liquidity. It's a real issue in case of real estate, because when you like if you're planning to buy, it takes time to find the asset matching your criteria, and but when you're trying to sell, that takes even more time, right? Sometimes it might take months to sell, and then and if you're in hurry, then you might have to sell for a lesser price, right? And that is not the case with equity. So if you're planning to sell today, you can sell it, and then you'll get the money in your bank in 2 3 days, right? So I think that is one aspect which everybody should consider, that if you are investing, you are investing to meet certain financial goals, right? And if you are not able to get money on time to meet that particular financial goal, so then at least for me, that's a kind of a deal breaker, right? So that aspect you should always consider whether that makes sense for you, right? And second part is like which everyone is aware that in terms of returns, right? So you should not compare the returns of like last 5 years, like 1 or 2, or even 5 years is like very short duration, right? You should consider the return over a period of 10 years or more, right? Because sometimes people say, hey, I purchased this property and in 5 years got doubled. Then you will also hear example that people purchase some stock and got like 10 times in 5 years, right? So don't go by that, but based on what historical data suggests. So if you look at the period of 10 years, the average return you can expect from real estate is around like 7 to 8%. And with that rate, you can expect your money to double in like 10 years. And then you will also get like 3 4% of dividend yield, sorry, the rental yield. So it might be in the range of 10 to 12%, right? But in case of equities, if you invest in large cap index funds, you can expect around 12% annualized return. In case of mid cap, it's around 15%, and for small cap, it can go up to 18%. So, and again, your the risk and volatility would also increase as you go into mid and small cap. So, but the overall return is like between 12 to 18%. So that is in long term, it's always going to be higher than real estate on average basis. So we cannot compare like one asset to one stock, because we sometimes a particular property or a particular stock can perform like outperform, but we need to go by what average return we are getting in a particular asset class. So based on that, equity returns are always on the higher side. So then, and one more aspect I just wanted to cover, since you are talking about the returns. One thing people don't consider that in real estate, you are kind of competing with the black money. That's my view, right? Because in people who are, you have option to invest in real estate with black money. So people pay like say 50% in cash, and which is not tax paid. And so if you see, effectively their cost is less, right? Because the money which they paid, or the part of cost which they paid, there was no tax paid on that amount, right? So the cost is lower, because if you are paying from your salary income, you're buying an real estate from your salary income, it's already tax paid. So to pay that 70, you need to earn 100, right? So your cost is higher. So for them, if they are getting 10-12%, that's still good, because they don't have any other option, right? But you are buying that asset with your tax paid money, so you need an higher return to compensate for the tax which you are paying, right? And that you can only do with equity, and that option only you have, right? The people with black money don't have that option to invest in the stock market, because here you need everything through bank accounts, KYC, and things like that, right? So that's also something we need to consider, that when people say that like real estate is a good asset class, it's for whom, right? People with black money, obviously this is a very good like asset. But if you are somebody like who is earning their salary, paying the taxes, then is this still the right investment for you? Is something you should think about, right? So, and then the next part is the transaction cost, right? So, and that's also linked to the returns, overall returns. So for example, if you buy a property, you upfront you're paying like stamp duty and registration cost, which is like 7-8% at least. And then at the time of selling, you might be paying some brokerage, so say 1%. So there is a significant cost involved in dealing with real estate, right? And uh, and but when you're dealing with inequities, either if you buy directly from like low cost brokerages, then there's no like it's hardly 0.1 or 0.2% of the transaction cost. And even if you're investing in mutual fund, you might pay say up to 1% of commission to mutual fund to manage your money. So it should be between like less than 1% of the your investment value. But in case of real estate, it can be 8% or even higher. So that will also have an impact on your overall return. So that transition cost is something that is also need to be considered, right? So, and that's next is, once you get your return, then what is the tax implication, right? So until this budget, like the recent budget, there was like a huge difference in the taxes, like short-term capital gain tax on real estate versus real estate versus equity, and the long-term capital gain on real estate versus equities. But still now, uh, though the long-term capital gain is same, like 12.5% for both real estate and equities, but the number of years which is required, the number of like period, number of years in the holding period which is required is higher for real estate. So you need to hold the asset for 2 years to classify that as a long-term capital gain. But in case of equity, it still qualifies as long-term capital gain if you're selling that stock or mutual fund after holding it for 1 year, right? So that advantage is still there. And if you're selling in the short term, right? So if you're selling within 1 year, the shares, or selling your property within 2 years, there's still a good difference in the tax rate. So for short-term capital gain on stocks or mutual fund, you're paying 20% tax. And the short-term capital gain for your real estate is still charged at your slab rate. So if you are in 30% slab, uh, you're going to pay 30% tax on your real estate short-term gain. So that is still like the tax treatment is still better for equities compared to the real estate. And then next, which is like a very important aspects, which again, I don't know if I think most of the people ignore, that regulations, right? So earlier before RERA, I don't think there was any kind of regulations in the real estate space, and people had to go to like consumer courts and other courts to get the disputes resolved with the builder or buyers, right? So after even after RERA, though RERA was formed with the right intention, but still I don't think real estate is that much regulated because still you see the frauds happening, and then like projects are not getting completed on time, and then and because in some state RERA has been diluted by the state, so there are still multiple issues there. But if you look at the equity space, right? The entire equity market with this mutual fund, shares, future and options. So entire equity markets is regulated by SEBI, or the Security Exchange Board of India, which is a very strong regulatory body, right? And over the years it has matured, and then and the compliance has increased, and it has ensured that the chances of frauds or mismanagement, right, in the equity market space can be minimized, right? So that gives you that confidence that if something goes wrong, SEBI will take strong action, right? So, for example, you see if there is some insider trading case, or there is some mismanagement in the mutual fund, you will see in the news that they take very strong action against that, whoever is involved in that mismanagement or fraud, right? So that kind of actions is not that visible in case real estate space. So that the comfort which at least I'm getting in from investment in equity due to a strong regulator, the same kind of comfort I don't get in case of real estate. So that's also an important aspect when you're investing for long term. You need to consider what kind of regulations are there in that space, right? Next is the diversification, right? So, thing is, real estate transactions are often like they are high value transactions, right? So, if you have only one property as your investment, right, or maybe two properties, and sometimes that's your entire portfolio, right? Or people even invest their entire net worth in real estate. So in that case, uh, it's not diversified, right? So you are investing in one asset class, and in that asset class also you are buying one or two properties, right? So if something goes wrong, right, maybe there was some fraud, you didn't get that project on time, or there was some structural issue after you got that property, right? Or maybe the property price got stagnated, like after you purchase that property, right? So you are not getting even inflation beating returns out of that property. So but now you cannot diversify, right? Because you are stuck with that one big investment. But in case of equity, even if you have a smaller capital, say if you start with 1 lakh, right, you can still buy like 10, 20 different companies, like stocks of 10, 20 different companies, and diversify. And if you invest through mutual fund, you can like even diversify, like they invest in like 50 or even more than 50 different companies, so it's even more diversified, right? So you need to think also about diversification, because if people are investing their entire net worth in one asset class, I think that's a very risky proposition. And but if you have a very big portfolio and you're investing a small portion of that in a illiquid asset, or that still makes sense. But investing the entire net worth in one asset class, and that too is which is not diversified, I think that's a very risky proposition, right? So, and then the another important aspect is like which people often ignore is the retirement withdrawals, right? So for example, if you're investing, what is your goal, right? Sometimes if your goal is retirement and you want to uh, withdraw that money for your retirement expenses, or to meet some other goals during retirement, right? So you know that so people would say that, okay, I'll give that property on rent, and I'll get that rent, but that rent is like 3-4%, right? So if it's 2 crore property and you are getting say 6 lakh annual rent, which is 50,000 per month, it might not be sufficient to meet your needs, right? And also, like if you need a lump sum, say 10 lakhs or 20 lakhs, can you take out that 10, 20 lakhs out of that 2 crore property? No, right? So that is some liquidity risk which real estate can create if you're relying that as a asset class, right? So that also you need to consider. So don't, that's why we say that like don't be asset rich and cash poor. So I think that is something which works very well with equities, because if you want to withdraw certain, like say 1% every month, or and then if you want to withdraw say 10% of the portfolio, right, that you can still do, right? But that's not possible in case of real estate. So I think, hope this points or whatever aspects we discuss gives you a more complete or comprehensive picture of investing in a real estate versus equity, and which will help you to make an informed decision. So which asset class is the right fit for you. If you like this video, please hit the like button, and subscribe to the channel if you have not done already. And don't forget to share it with your friends, colleagues, or with whomever you are having this real estate versus equity discussion. And I'll see you in the next video. Thank you.